few years back, in a less than charitable moment, when asked about growth, a reinsurance CEO said to me that he likened reinsurers to fish chasing scraps of bread around a fish farm. There is an argument that in a largely following market, it is tough to drive up aggregate demand, and that the key to success is how to differentiate yourself in a red ocean. In the current environment, when interest rates are low, or if you look at the ECB action last week, they're non-existent, there is a clear pressure on underwriting. But when you look at that and the current environment there, it is hard to see near-term respite. And as we heard from panelists yesterday, when you put that against the melting pot of protectionism, regulation, two-speed growth, and disintermediation, one can sympathize with reinsurance executives as they try to secure a foothold in shifting sands. And that is what they must do, because stabilizing today's operating model is absolutely critical in order to be in a position to innovate and drive up demand for risk transfer. In spite of all the potential challenges, we see great opportunity that can be seized, and some of that was tabled in our panel sessions yesterday. It would, of course, be entirely wrong to view limited growth in traditional markets and a range of disruptive new threats on the horizon as being an acceptable norm. Panelists discussed yesterday the importance of being extraordinarily good at what we do, namely getting closer to customers, understanding their perspectives and issues, and responding innovatively, more as a risk partner than a risk taker. And by being in Bermuda, the center of innovation and risk, you're here in a great week, and not just because of the rugby, but because I firmly believe that this domicile is at the center of how risk transfer will evolve over time. I am not saying ILS versus reinsurance. Both markets are struggling with the same issue, that of finding new and meaningfully profitable sources of demand. What I am saying is that over the last 12 months, you have seen this domicile engage and evolve in spite of the variety of disruptive forces out there. It has worked to better serve the needs of policyholders, investors, and stakeholders, and to drive changes in an environment where the inevitability of inaction now will lead to irrelevance in the future. And what is behind this? I put it to you that it is, as it has always been, the entrepreneurial and innovative skill of the intellectual property that resides here. As Dr. Gibbons put it yesterday, Bermuda is open for business, but importantly, it is also shaping risk transfer for the years to come. More on that in a bit. We're in for a great set of panels this morning, which starts with the chairman's panel with three industry heavyweights, which I'm pleased to be hosting. That will be followed by S&P's panel, Growing Pains, Generating Sustainable Profits Amid Challenges, which is hosted by Dennis Sugaru. At 10:30, we'll have a quick 15-minute break. Then as we return from the break, we have PwC's Colm Homan hosting a session called The Meaning of Life, which will look at topics in the life reinsurance industry. We will wrap up with S&P's ILS and Alternative Capital panel hosted by Rodney Clark, and then conclude the conference with closing remarks by Farouk Omar from S&P. Before we get things underway, I'd also like to mention that David Law, PwC's Global Insurance Leader, and Brian Joseph, PwC's Global Actuarial Leader, are both joining us here this morning, and we'd be delighted to meet as many of you as possible between now and the end of our sessions after lunch. So, without further ado, thank you again very much for your continued support. As I said yesterday, this is our 8th annual event that we do. We're very proud of the debates that get stimulated and the topics that get surfaced. So I do hope you enjoy this morning's panels. With that, I'd like to welcome, or ask you to welcome, in the traditional style, Ed Noonan, Don Kramer, and John Berger, who will act as the panelists for our first panel, the chairman's panel. Thank you. So, good morning, gentlemen. And just to get things underway, I thought I'd ask for your perspectives broadly or specifically on where you feel the industry is today, where reinsurance is, any broad-based perspectives, maybe starting with you, Don.
Well, I guess I've been around the longest than any of you. The only way I'm ever going to get to be the youngest on the panel now is to get Warren Buffett and Hank Greenberg here. So I've got a long history in this, but things have changed dramatically in the insurance industry. Obviously, with no yield on investments, you've got to make it on underwriting. And there's a huge difference between short and long tail. What's interesting is that in the long tail area, where you have no interest income and you want to get underwriting gains, you've seen a wave of hedge funds come into the industry so that they can manage the assets aggressively and then keep it underwriting at a fairly constant level. And that's one issue in the industry. The second is in the short tail area. We've seen companies like yours do, like Ed's do, business with sidecars and the like to increase their leverage. And also we've seen the emergence of insurance-linked securities. So those are the couple of things that bring it in today. To get, for insurance-linked securities, you can't get yield anywhere else. Fixed income now is a dead loser if you have bonds. And equity markets are up 24%, record levels. So where do they go? So people are now taking greater risk to try to squeeze yield out. So insurance-linked securities have burgeoned. Those are the 2 of 3 issues that have really affected the industry. Ed?
I think I'll probably echo Don's comments, just because generally that's a good thing to do. Otherwise, Don will disagree with me violently. No, I think Don is right. We're in this interesting period of time globally where the world is both awash in capital and seeking yield, and yet there's relatively low growth in the global economy. So the fundamental demand for things like insurance coverage and derivatively reinsurance coverage is growing very slowly, if at all. Whereas the supply of available capacity, people willing to take on that risk, either as underwriters or in asset management, continues to grow at a pretty rapid rate. And so that's the world we live in. And it's different than, I think, any time that I can recall in the industry, but not different in the sense that, it's insurmountable. There's only fortunately a few key levers that you have to work with if you're managing an insurance enterprise, and that's underwriting income, that's your capital base, it's your asset management strategy. And so I think this current period of time just kind of shifts our attention to use those levers differently than we might have. And so I think if you look at the industry, it's being very disciplined in returning excess capital. It's, I think, being disciplined in looking to access third-party capital either as a manager or a user of that capital to manage risk more efficiently. And generally there's good underwriting discipline across the industry. We'll find out about how good price discipline holds into 2014, but today the industry has these challenges, but is generating reasonable returns, not the 15 or 20% returns that we'd all like, but as a function of the spread above the risk-free rate. The industry is about where it always is. It's somewhere around 1,000 points above the risk-free rate. And so it's a very different time, but the fundamental tools that we have to work with seem to be being used well to kind of navigate through it.
First of all, it's humbling to be called a heavyweight. Before I came up, Noonan said, "Berger, you're a lightweight. You always will be. Don't let it go to your head." I mean, if you look at our industry, it's never been in better shape. Surplus is at an all-time high. Reserve strength, the redundant reserves is unprecedented in the strength we have. The intellectual capital we have. I was talking to Brian, the PwC actuarial leader. PwC has 1,000 actuaries. You look at Guy Carpenter, Willis, Aon, the number of actuaries, PhDs in math. So I think overall, the industry's never been in better shape, and there seems to be this big pool of capital, people with their nose pressed up the window trying to get in. Over time, our industry has been great at destroying capital. I have great confidence that that will happen again. The test will come when there's a series of losses, a financial crisis. You'll find out there's some people who have more exposure than they should, and then we'll see. Then that will be the test to see how good the industry is. Right now, point in time, as Ed and Don, they said, there's supply coming in and demand isn't going up. So you know what that means. You don't have to have a PhD in economics to know prices go down. So we'll see how this plays out.
Thank you. We hear a reasonable amount that comments like if there's a paradigm shift in reinsurance, that the industry will never be the same again. You talked about some fundamental changes, but it's not insurmountable, I think was the phrase you used. Do you think there are big structural changes that need to happen with reinsurance organizations of today to be able to cope with the future, or is this part and parcel of another disruptive cycle that we might be going through where, as you, I think, said, Ed, some reasonably straightforward, if I may call it that, levers can be adjusted and manipulated to navigate through the current situation? Where would you position ourselves in the industry today?
I think the challenge for each of us, regardless of what your angle of approach to the industry is, whether you're a long-tail company, short-tail company, doesn't make any difference. We're in a period of time where you have to adapt. The world is changing around you. The supply of capital to the industry is seemingly limitless. And so, we have to be able to integrate our business models in a way that the risk that fits the capital that our shareholders have entrusted to us gets used for parts of the risk distribution that can generate attractive returns, and the parts of the risk that we all look at and see every day that don't meet our returns but may meet someone else's returns. We have to be able to adapt and manage that capital and bring that risk to those parties. Not everyone in the industry has to do that. I think you can survive nicely in the industry without managing third-party capital. It's just a different model. In our case, we seek to be one of the bigger players in the global catastrophe market because we think that gives us more influence over price and terms and conditions. And so part and parcel of that, in addition to a very, very big research team and what we think are first-rate underwriters, we need to be able to manage third-party capital. But other strategies, I can easily envision saying, no, we don't need to manage third-party capital also. That's one area that we have to adapt in. And then, frankly, the ILS market helps us all in a great way also. If you think of where they predominantly deploy their capital, it's in the high layers of risk. And those are the layers that are most capital consumptive, and therefore not the best use of our shareholders' capital. Over time, we've all written those layers, but mostly we wrote them because we wanted to get access to lower layers of the program. And so moving that business into a capital base that it fits better actually helps us. And then, of course, on the back end of our business, that additional capital allows us to go out and purchase retrocession or other hedges from people who have a lower cost of capital than we do for that type of risk. And so that enhances our overall portfolio. So, in each case, each business model, you have to be able to step back and say, all right, if the world is changing, how do we adapt to that? So in our case, that's what that looks like. I think in John's case, it's a very different business model, but still adapting to new forces taking place in the industry. And I agree with John's comment. He is a lightweight, but we should probably get his views nevertheless.
John, comments?
Thank you, Ed. Ed's company is really, I think, a great model for capital management, flexibility. People think the expression is the fittest survive. It's the people the species that adapts best survives. And I think in today's global economy, capital flows. So right now it's flowing in. It's not inconceivable one day it flows out, right? So everything happens much more quickly. Time periods are compressed. And so it's the companies that can adapt. If there's cheaper capital out there, you have to access it. Because if you don't, you're going to be sitting on the sideline watching other people.
Don, any thoughts?
Let's talk about the paradigm shifts in the industry. Demand generally is inelastic. And it depends on growth of the economy in the world, and we don't see much of that now. So demand is not the issue, it's supply. And if you go back to where the industry, let's look at the industry's capacity going back historically. John's old company, Chubb, 30 years ago, Chubb used to write 2-to-1 premiums to surplus. That gave them $3 of invested assets. At 7%, they had a 21% return on investment income on equity. And then if they had a 98 or 99 combined ratio, they made a ton of money. If they had a 103 combined ratio, companies made money. So that on that basis, the industry was very heavily leveraged. And in fact, I go way back, but in 1974, St. Paul had 100% of its assets invested in common stock. The market went down 30%. I don't know if anybody remembers this. And they were forced to sell their shares at the bottom of the market, and they became the Mad Bomber of Wall Street. That was their appellation for many years to come. Companies don't own 100% of their equity in common stocks anymore. The second thing is they don't have 3-to-1 leverage. Now, if you look at Chubb today, and it's a first-class company, it's only 0.8-to-1 premiums to surplus. And if you look at the investment income, which used to be 21 or 22%, is down to 8%. So what's happened is we've had a deleveraging in the industry. Then you look at the reinsurance industry. When I first came here, my second time actually, my first time was 1974. When I came here in 1993 following Hurricane Andrew, we raised $500 million. We wrote $300 million of premium. When I did Ariel, we raised $1 billion. We only wrote $300 million of premium. So there's been a tremendous reduction in the leverage of the industry. Now, supply then has come in, but it's been massive. The amount of supply that's capable coming into this industry is in infinite amounts. And the reasons clearly are the alternative asset investment opportunities are so limited right now. There will be a time when interest rates go back up. And so you're in very interesting times. If you're a highly leveraged company and you have $3 invested assets per dollar of equity, you have the risk that when interest rates go up, you'll take a huge hit. Now, we're at a unique time. The market's up 24%. All of the major stocks are trading now at or above book value. So we're back to where we were in the 1993 era from the price to book value. We're just not getting it on the investment income side. And that's why we see more focus on risk.
So maybe let's pick up the point on interest rates. There was obviously an announcement just about 7 days ago in Europe. There's discussion about deflation rather than inflation. There's no obvious respite for a number of years to come. What are your perspectives on taking investment risk and how that balances up against underwriting risk? Clearly, there are different strategies at play in the market today, but will those strategies potentially change over time as we see no real movement in the fixed income market?
Well, I think with Ed's company and our company, you have the two bookends where we have an extraordinarily aggressive investment policy. A hedge fund manages all our money, big short, long short equity portfolio, activist investing, the third point with Dan Loeb. And because of that, we're more conservative on the underwriting side. A company like Validus, that is really one of the premier short tail specialists in the world, are extremely cautious and conservative on the investment side because of all the volatility on the underwriting side. And now we're starting to see companies go in between. You're seeing companies buying into hedge funds. You're starting to see people, well, we should allocate more to alternative risk. That's a tough business for our industry. We're not great at investing money in general. And so there's a lot of movement going on between where we are and where Validus is.
I think John sums it up perfectly. In our case, we have $8 billion of assets with a duration of 1.5 years. They're all fixed income assets with very minor exception. And so there is no investment income in the business. We invest our money essentially for security purposes, solvency, liquidity, and there's no return in it. I think before you make the conclusion that John's investment strategy is perhaps risky and ours, extremely secure, there's no place to hide. When interest rates are at this level, having an $8 billion bond portfolio also carries some, risk as well. And movements in interest rates, will hurt the entire industry when and if they do come, and ultimately they do have to come. So I think one of the things that I observe is for us and probably everyone in the industry, we're spending more time thinking about asset management strategies. How can we remain as conservative as we are, but not leave ourselves so vulnerable even to, small movements in interest rates given the size of our bond portfolio. And I would expect to see the industry asset distribution change over the next couple of years. I wouldn't expect to see radical change. You know, even if I thought that John's investment strategy fit our business, you can't get from where I am to where John's company is, maybe over a period of many years, and that wouldn't fit our model. But I would expect to see the industry start to shift now. I think you're seeing more people investing in private equity and alternative asset strategies. Part of it is chasing yield, but part of it too is you know, escaping the notion that a pure bond portfolio, regardless of the quality, carries no risk.
You know, I'm sorry. What's interesting, so it sounds like our company, the volatility in our company is very different from the volatility in Ed's company. It is, but if you graph volatility over time of a short tail reinsurance company and somebody who had hedge fund investments, the volatility is actually very similar. So we're talking about natural catastrophes upsetting things at a Validus. Economic catastrophes add the volatility. So actually, from a volatility risk standpoint, we're very similar. It's just which side of the balance sheet you're taking it on.
So the message to everyone in the room is you should be buying both stocks.
Long, short, you'll be in good shape.
I really think you have to step back from the insurance industry itself and look at the global economies. We're on the very edge of a move between inflation and deflation. And it's frightening. If you look at the Fed, I think the rates were inflation was 1.2%. And when deflation comes, it's devastating for a lot of the countries like the United States with massive amounts of debt, and all the other countries that are loaded in debt and have massive amounts. So they're terrified of deflation. On the other hand, we're looking at a rampant inflation if we run it the wrong way. And so we're right now on that cusp, and you have to watch what happens in the economy. It's critical for understanding where we go in the various segments of our businesses. And as I say, the Fed feels that about 2.5% is about the right inflation number to have annually in order to keep the economy on a level basis. And as I said, we're at 1.2. So that's a key factor. Then you got to look at the portfolios of the companies and see where they're going. And I agree. I guess you almost describe it as elemental versus versus interest rates in terms of looking at two companies. And both of them are I have to admit, very well run. Yeah, come on. It's true.
Don, you talked a bit about where companies are trading at the moment. It's certainly a good change to see from prior years. Do you think that rather puts off whole company M&A at the moment, or do you think consolidation in the industry would be a stronger driving force at this point in time?
I'm not sure. I mean, if you look at what Ed's done in consolidation, he's built a very large company and significant. I mean, when I came here, when I joined ACE, we had $1 billion market cap. Today, it's a $40 billion market cap. It's been a hell of a run. But I don't know where that further consolidation would benefit these guys. And remember, the reinsureds want to see diversification. They don't want one company to have 100% of their business. They don't want either it's Swiss Re or Munich Re or your company to have 100% of their treaty. So they want to have counterparty, if you will, lack of counterparty concentration. So I don't know that we're going to see a big merger consolidation boom.
Ed?
Yeah, I mean, from our perspective, further consolidation for us in a catastrophe space has diminishing returns. For the point that Don makes, there's only so much of a program that people will, allow you to have. So taking over another catastrophe reinsurer, we'd end up holding a much smaller portion of the business that we had acquired, and so that loses its attraction. It's an interesting time in that, as John pointed out, the industry is performing very well. It's good discipline. Returns are good. Even the laggards are able to feel comfortable in their strategy today. And I'm not pointing fingers at anyone, and by no means will I exempt anybody who might hold that view of Validus. But I think if you're an executive in the industry, your stock price has risen nicely. Returns may not be great, but they're not so bad compared to everything else. So you're not likely to throw in the towel and say, gee, we should probably sell the company. So you don't have willing sellers. And from experience, I can say if there's not a willing seller, it's a bit of an interesting process to try and change their mind. So I think that M&A, whole company M&A is less likely, but by the same token, the whole industry is awash in capital, and so no doubt people will be out looking, and some more aggressively than others. So I wouldn't be surprised to see continued M&A take place, but my sense is it will probably be smaller companies, not larger companies that are being acquired. And so kind of more of the same. That won't take the excess capital out of the business. That will be mostly at the margin.
Okay, thanks. John, any thoughts?
Yeah, I agree with all that. I think there are a couple other things in play. To the extent supply comes in and margins are squeezed, there's going to be more and more focus on the expense side, and that could be a driver of M&A, where you could basically assume business, and unfortunately employment goes down. And it's not a recent phenomena. It's been going on, but it just seems to be becoming more and more prevalent of really first-class runoff companies, where you get a company that gets in trouble, and in the past, somebody would buy them for the ongoing business, and now you get a runoff business, a runoff company that basically shoots them, right? Really just kills everybody, gets rid of everybody, and just runs the company off. So I think with that, that mitigates M&A activity.
Okay, thank you. Don, you made the comment earlier that the problem's not demand, it's supply. We had a number of conversations on various panels yesterday about where there are potential opportunities to bring capacity into the market, increase demand. Are there any perils that you see as being currently underpenetrated by reinsurance that you feel could be new growth areas over the next 12 to 24 months, possibly?
I'm not sure exactly growth areas, but I see areas of demand. Marine and energy, for example, has had a tough year. If you remember, the Concordia and another major ship went down into some very large marine losses. We haven't had any aircraft losses, aviation, but marine is now a hard market compared to the other sectors. They're talking about 20, 30% increases, but that's hard to hold because a lot of ship owners then self-insure. So it's not quite that big, but that's an area of a hard market. I don't see growth in massive growth areas at the moment. You've got to grow with the economy and with the world at large. And I don't see sectors where suddenly people are rushing to buy reinsurance.
Yeah.
I think the two areas that stand out to me, Arthur, first, and they're both in North America, you have the U.S. federal government running the flood program. It served its purpose. It's long since
they've done a typical great job. They have a $30 billion deficit.
Right, and it's outlived its purpose in a sense that, at the time that the flood program was put in place, the industry felt it couldn't deal with flood risk. It was too big for the industry, and the requirement to provide coverage mandatorily just made it unacceptable. Well, it's been, we probably could have gotten rid of the flood insurance program a decade ago, but certainly today, the private industry could take over the flood insurance business, and particularly with capital coming in from third parties that would dearly like to play at the high layers of risk like that. There's no reason for the flood program to continue on. The private industry can take it over. The government is in the awkward position now of trying to get actuarially sound rates, and that requires a multi-year phase-in. This is probably the perfect time. Rather than have the federal government sending rate increases to policyholders, the private industry should step in and take the heat for raising rates, but take over the flood program. The second area that I guess Congress is looking at today, and we'll have to do something about over the next couple of months, is the reauthorization of the terrorism program. And there's really two very different things at work. There are some terrorism risks that I think a prudent person would say are uninsurable to the industry. There's no way that we can understand nuclear, biological, chemical, or radiological events on a scale that would allow us to, take that risk. Or if we took the risk, it would be very tiny and it wouldn't address society's need. The other area that falls in that category is cyber terrorism. The ability to take over control devices, sophisticated infrastructure plants is beyond our scope to understand, to imagine. The government has much more knowledge about it. And it's just, at this moment in time, unquantifiable, and so not a good matter for insurance. But conventional terrorism risk, and I don't mean to downplay the human toll of this at all, but conventional terrorism risk looks like people blowing things up. The scale of non-nuclear weapons, we understand. We know what a 10-ton truck bomb does. We know what 4 pounds of plastic explosives do. We understand those things. And the private industry could easily step in and begin to take over the conventional terrorism risk. You can't do it overnight. We couldn't flip a switch and say, let the private industry take it on. It would be too disruptive. But with the amount of capital in the industry, that's another risk class that it is subject to modeling. It is subject to aggregation and risk control. Assumptions have to be made about frequency. And so that's kind of a rate parameterization that has to take place. We won't get it right out of the gate, and we'll probably err on the conservative side, I suspect. But that's how new products work, and that's how the industry should be stepping into the conventional terrorism marketplace. And so that would be our great hope, that the government, over a 3 or 5 year period, transitions out of the terrorism program for conventional terrorism risk and turns it over to the industry. And I think the industry is well prepared and able to deal with that risk. So those are a couple of very big risk categories and soak up a lot of capital, a lot of the excess capital in the market. But beyond that, I would agree with Don, there's just not a whole lot of economic growth in the world, and so nothing else that jumps to mind.
John, any thoughts?
Still, 85% of the world's property casualty premium is in North America, Western Europe, and Japan, and these are slow-growing economies. So absent the areas Ed talked about, it's hard to see those economies being the locomotive for our business. The emerging markets are growing quickly, but they're still relatively very small insurance markets.
Just to pick up on your latter comment, and then I'll come back to get your comments, Ed. Is it really just a longer-term strategy for Western reinsurers, if I can call it that, to establish presence but play a much more patient game in those emerging economies until we see GDP per capita change, commercial property insurance coming online, things like that? Is that really what the structural impediment is about not being able to more rapidly assimilate advantage and penetration into those emerging economies? That's something that was discussed yesterday.
I think, China, everybody talks about China. Not that long ago, there was no private property in China. I mean, you need a big middle class, you need consumption, you need people who want to protect their assets. So it's going to grow, it's growing dramatically, it's still very small, and I think those are the dynamics in all the emerging markets. So it's just a matter of time, but I think the time horizon is quite long.
It also requires a lot more data. Just 3 or 4 years ago, the Chinese market was in disastrous shape. Companies were failing, losses were staggering. We've now seen a number of reinsurance companies open up in Hong Kong and starting to move into the Asian market. But if you look at the results so far, they haven't been terribly successful. Asia Capital Re, I think, is one of the large companies. And if you compare them to one of the Bermuda domestics, at Ariel, my old company, we earned more in the first quarter than they earned in the best of any of their years. So it still takes a lot of data managing and understanding what the risks are and understanding what the local laws are.
We've had a bit of a different path. Owning a big Lloyd's syndicate, a big insurance operation that focuses on things like marine and energy reinsurance and offshore drilling. It's a very natural thing to go where the business gets placed. So historically, business from Asia would mostly get placed in London and a few other markets. Increasingly, as those economies are growing and developing financial institutions, that business is being placed to a greater percentage locally in places like Singapore. Pardon me. So for us, opening up an operation in Singapore first for our syndicate was a very natural act. It was business that we've been seeing for the most part for decades, and now we're seeing it in the local market. And so, even in the absence of a robust middle class, if you think of the amount of shipping coming out of China or Japan, the Asian market can absorb more of that risk, and so it gets placed locally. And so being on the ground there as a Lloyd's syndicate allows us to continue to participate in the risk. Certainly offshore drilling, it's a high-risk venture. Very significant values involved. They need global capacity, and so it's a natural place for us to play. And because those are risks that require global capacity, they're not priced as competitively as pure local market risk. From there, I think both John and Don pointed out the need for a robust middle class for insurance really to take off. But if you think of what's happening in China and the demographic shift and the income shift taking place in China and the ownership of private property, you do easily imagine the amount of demand for catastrophe risk for both earthquake and wind that will emerge. With China, it's always impossible to say when that will emerge, but there's an inevitability to it. And so being in the local market, I think, is valuable, developing the relationships and the context. Right now, it's not a particularly great time to take lots of risks, but being in the market has value there. And so as a reinsurer, we have good relationships, but write a very small account. And we're very happy with that, and that served us well in 2011. But as a direct insurer, we continue to grow. We've made good money. We've been in Singapore, I guess, for 6 years now. The returns are good. It's business that we know and we like, and it isn't foreign to us. And the thing that I think easy to overlook, and maybe for Bermuda, an important element, if you go to Singapore, what you see are very big buildings full of very bright, polished, well-educated, dynamic locals from all over Southeast Asia, but very high-quality young people. And they're building their careers, and you can easily look forward 10 years and see that this is going to be a major financial center, a major competitor for the island. And so this is the right time, I think, for Bermuda companies to be putting themselves on the ground in a place like Singapore and becoming part of that, lest they become kind of run over by it.
And I just, Ed, do you have any perspective on what Bermuda's exposure is to the Philippines?
Very, very slight. Yeah, very slight.
You gave two examples of potential areas of growth, flood and terrorism. There's been some discussion publicly about those two markets being ripe for ILS-type products rather than traditional reinsurance. Perhaps using it as a case study of the industry today, where do you see the demand coming from, and what types of products would that market look for? Are you fairly ambivalent about which one is delivered to those markets? Would it suit one versus the other, or is it horses for courses based on what risk managers are looking for?
Well, I think Don and John will both have unique insight to this as well. I think the flood peril is the one that's most easily transited to the ILS market. Got outstanding data and years of history to be able to price risk on, to be able to analyze and understand risk on, and create indexes around, which are helpful in converting insurance risk to the ILS market. So I think flood is a natural fit, and has most of the same attributes as wind, and so easily dealt with in that regard. Terrorism is different because of the lack of a good historical database and the ever-changing nature of the terrorism threat, which kind of renders historical events sometimes meaningless in trying to project forward. So that's a harder case to make for the ILS market. But that doesn't suggest that there isn't other capital that wouldn't come in specifically to take that risk. Maybe not 1 or 2% of their pension portfolio, but maybe 0.25% of the portfolio, because it doesn't correlate with everything else they do to the same extent. But flood doesn't correlate with the return on stocks or bonds. Terrorism can, as we saw in 9/11, but mostly on a short-term basis. And so there's still some benefit, I think, for investors who are looking for diversification and additional places to get yield. But as I say, I think both Don being in that space today and John probably have interesting perspectives on it.
John?
ILS investors are obviously sensitive to excess volatility. They're trying to generate yields that are somewhere substantially higher. Not junk bonds, cat bonds have really come down dramatically in terms of their price. The yields on the cat bonds are now 4%, 5%, depending on probability of loss, when there were periods when they used to be 20% rate on line. And so the ILS investors are looking to try to use portfolio analytics to try to keep the volatility down. Because the investors in this sector tend to be pension funds and other types of institutions that are taking greater risk in order to get an alternative but higher yield. And they're not really pleased to see very large losses. They would hate to have a year where, well, one year they have a 12% return, the next year they have a 12% decline. So I think those risks are very difficult to manage within that kind of structure.
I think, like in any market, there's a broad array of very smart, sophisticated people, and people are less sophisticated, not as intelligent. I always love the story about Joe Kennedy, JFK's father, got out of the stock market before the crash, in the 20s. And he said what tipped him off is one day he was getting his shoe shined, and he heard the shoe shine men talking about the stocks they were buying. And he said, whoa, time to get out. I'm not sure all the alternative capital that's come into our market really understand the risk they're taking. Do they understand they're taking cat risk at 4 online? They think it's a cat bond. They think it's a bond. They think they can sell it. They think there's recovery. One day they wake up and it's gone. Do they really understand that? A lot do. I'm not sure everybody does. So the test in all this is like anything, is over time. And in times of duress, times when it's stressed, that's we're going to see. We're going to see how durable the current model is.
That's actually a great point that John brings up. The reinsurance product is a great product. The breadth of the coverage, and it's been time-tested, litigated, arbitrated in every way you can imagine. And so there's a great predictability around the traditional reinsurance product. A disturbing number of the cat bonds that have actually been triggered are currently in litigation. And so I think that's clearly a sign that it's very, very early days in the catastrophe bond market. You don't have well-worn legal paths and rulings to rely on. And so I think the world, little by little, will come to that, but there'll be winners and losers, people who thought that they had bought coverage and don't get it, and people who didn't think they provided that coverage and ended up having to provide it. I think we also don't know what happens, if you think about big events in our industry, natural disasters, oftentimes late in the year, September, October, and given that these are collateralized products, the collateral has to remain locked up, and so it can't be underwritten against the following year. That will remove a lot of capacity from the marketplace. Now, if you're a hedge fund, you'd say, great, prices are going to go up, I'll reload and add more capital to write next year. I think it's an unknown as to what the average pension plan will do. Will they move with that type of alacrity? Will they see opportunity the same way people in our industry tend to see opportunity, or will they say, gee, looks like we just took a big loss and we should go slow, or wait to see how it plays out? And so I think that's an issue. And then ultimately the collateral release, if you look at what's happening in New Zealand now, the 2 earthquakes, we're far enough out that it's not surprising that we might have some development being reported by the local market, because earthquakes are tricky. But the magnitude of the development being reported by the local markets is really quite extraordinary. And to the extent that that risk is securitized, it means that capital, that collateral, has to be held for a much longer period of time than perhaps people would have expected going in. And given that the capital is tied up, it's not generating ongoing return. And so I think there's a lot left to be played out before we understand and reach that point where all the mechanisms are in place and time-worn and trusted, and where all the litigation and legal rulings have taken place that make the product perfectly viable. And so, there's room for surprises, I think, as John is pointing out, that, are people getting what they bargained for in
Right.
the end?
But there's also a blend between risk management, which is what a lot of the people here have great capability doing, but also investment management. And so you've got to create portfolio analytics and bring them into the question as well. So you can take a risk, but you've got to have other portfolio analytics. An example was one that happened 2 years ago, the Concordia. The Concordia was a loss, probably around $600-700 million. The underwriter underwrote it, he lost, bang, gone. But what he did was he bought an industry loss warranty at above $1 billion. Well, that loss was below, but then suddenly another ship went down, and suddenly that industry loss warranty was starting to go from $1 billion to $1.2 billion to $1.3 billion to $1.7 billion. So here he has this loss of the Concordia, and suddenly he has an arbitrage The greater the return there, he suddenly reduces his net loss. So it's portfolio analytics that have to go along with your understanding of risk analytics. And there are several companies on the island that do it. Your company does it, and I must say quite well. You look at portfolio analytics, Sharpe ratios, and other kinds of dynamics that you use in portfolio management, coupled with your analysis of risk management, and that will give you a better return. A lot of people, we saw the losses in Chile, may have been mispriced. A lot of guys took some very big hits. You know, you think this is 1 in 100. We don't know if it's 1 in 100. It now will be 100 years for them to get back what they lost in Chile. So you have to have risk analytics with portfolio analytics in order to try to keep your returns within a normal quant level.
Ed,
By the way, I should confess, Don was very nice in complimenting us. We were one of the guys that got tagged a bit in Chile. So it's always helpful to remember that you're absolutely as good as yesterday, and we'll find out how good you are tomorrow when tomorrow happens.
It's certainly an interesting debate. That the phrase pro-cyclicality has come up from time to time with reinsurance and the retraction of cover sometimes when it's needed most. I would echo the sentiments that whilst policyholders might be protected through collateralized products, it's that long-term investment into providing risk transfer solutions that is so important, and it's that potential distance between policyholder and investor that obviously people are focused on at the moment. Ladies and gentlemen, we probably have about 12 to 13 minutes left of the session. You've all had your coffees. I'm hoping there are some questions for these gentlemen this morning. So let me give you your first opportunity to ask them. There are some walking mics around the room, but if I could ask you to put up a hand, ask anything you like, I'm told. There's one at the back, I think, blue shirt.
Hello, Zach. Question for the panel. Where do you see the industry in 5 years, the reinsurance industry?
Anyone want to take that? I think you have to go through, just scenario analysis. We're basically on a run now of no big major North American or European storms. So if big events don't happen and the economies kind of muddle along, I don't think it looks that different than today. I think margins will continue to be compressed as supply comes in. You throw some curveballs in, some losses, some economic distress. That'll be the test to see who's really good at risk management, watching their aggregates. So I see, two ways. It's very similar, or under duress. It's different. How's that as an insight, Ed?
Could you go over the middle part again? I agree with John. I mean, we've been in this extraordinary period of time where there have been no major events in North America, and that won't last. And so I think you have to imagine that over the next 5 years, we should expect to see one or multiple events in North America. And that will have a significant effect on the industry. It will have an effect on the ILS space. And so I think, that's one of the factors that will shape things. There's an interesting thing going on today. I think Don probably, his background as an analyst, has the most insight to this. But historically, the insurance industry didn't raise prices until cash flow went negative. And it's not an easy thing to get an insurance company to get to negative cash flow. But that's when prices went up. What's happening in the U.S. market now for the last several years is rates are going up because they were inadequate. Cash flow didn't go negative. Companies weren't running major losses. There wasn't horrible adverse development coming through with only a couple of exceptions. And so the discipline in the primary industry in the U.S., and I would extend that through to Lloyd's, it's actually been quite extraordinary and different from the past. I don't see any reason why that will change. I expect that the industry will continue to be forced to price the product sensibly because of the absence of investment income. And so I would expect to see kind of an ongoing trend of broad rate adequacy. Not that every line will be perfect, but most classes of risk will probably be priced appropriately. And so impossible to know what will happen to the supply of third-party capital or events that may happen outside. But I think the industry is in good shape and actually very conservatively run and well managed today. And so that, I imagine, will continue forward over the next 5 years as well.
One of the key factors of insurance-linked securities is short duration. which means that it has ease of exit. If you remember in 1993, when 8 companies were formed, when the market went soft, those companies were still there. With insurance-linked securities, you have ease of exit. So that's one of the issues. Secondly is then you look at the economy and say, well, will interest rates go back up? Will that also lead to ease of exit and produce alternative investment places for a lot of this money to take lower risk and higher returns? Those are key factors in the industry over a long period of time. But over the next 5 years, I don't see significant change, other than I do think we're in a very, very slow economic recovery. I'm not pessimistic. I don't see a depression. But at the same time, I think we have long, slow growth. And so I think this industry will continue along pretty much the way it is.
Yeah, our industry is amazing. You think our casual conversation, really sobering stuff. So years ago, it was a social setting, it wasn't a business setting, and it was a dinner in Atlanta. And I'm sitting next to this young woman, and we're talking about, what do you do? And I tell her, I go, what do you do? And she goes, well, actually, I work at the Center for Contagious Disease, which is headquartered in Atlanta. I go, what are you? And she goes, well, I'm an expert in it. It was like, yeah, it's like, really? There's going to be a pandemic. She goes, it's just a matter of when, not if. When you look historically, you had the flu, and I think it was 1938, millions of people died worldwide. She goes, that's going to happen. So, the point of the comment is, you look out in the future, and we look at the risks we know about. Whoever thought that you'd get 757s crashing into the World Trade Center, right? So out of the blue. So a pandemic, a nuclear incident somewhere in the Middle East, what does that do to the world economy? So you have all these variables that are outside of anything that's ever happened. Doesn't mean they can't happen, right? They're out there. What do we look like after that? So those are, really sobering things to think about.
That was actually very nice, kind of pick me up this early in the day.
Ed's going to start wearing gloves now.
We're nearly there. Any other questions now, or should we carry on? We got one over here.
I was just wanting to ask about broker facilities, because we've been seeing more of them this year. Just wondering if you think that they're a soft market phenomenon or whether they're here to stay. And if they are here to stay, what does that mean for underwriting?
I missed the beginning of your question. Could you say it again?
I wanted to ask about the broker facilities that we've seen this year, the kind of Aon sidecar or the Willis 360.
Ed has very strong thoughts, so let me give you the soft view of it before Ed goes nuclear on us. We were talking to a broker the other day, and they said, listen to this. There's a company out there buys a big Florida cat program, and they will guarantee you'll get 20% of their program at market terms, and it costs you $10 million for that right. And Rob Bradle, our CFO, turned to me and goes, I guess that's the definition of a soft market. And that's how I view these facilities. It's people scrambling for premium, will try any way to do it. I think it's, my opinion, it's dangerous for the marketplace.
As a general point, every underwriter has to build his own portfolio. And if there's a broker that has a specialty area of risk that they're good at, they have a big portfolio of, there's nothing wrong with saying, gee, I'd like to see everything you place in the market. I think I can build a better portfolio if I do. And I'm willing to pay you extra commission in some way, shape, or form to do that. I think within reason, those are not, insensible things to do. But when you get to this point where you say, well, whatever you're placing in the market, I'll take 7.5% of. What you're trying to do is essentially track the market returns as an index. But the problem with that is that you're also following the weakest underwriters. I describe it as every risk that we decline, that we say, my God, this is garbage, I would never write this in a million years, Berkshire Hathaway takes 7.5% of. And so, the entire notion of underwriting is risk selection. We had 2 notable terrorism events this year that we avoided, which you have to think of as good fortune, but there was underwriting involved as well. We declined the Boston Marathon risk because we felt the pricing was too cheap. We had no insight beyond that, just the pricing was too cheap for the risk. And we had been on the Westgate Mall in Kenya for a period of years, and had gotten off it as price and terms and conditions had softened. And so we avoided those 2 losses. And if you're in the terrorism market, that was the majority of the loss in the market this year, and they were meaningful. So if you're just tracking the market, you're on both of those risks. You've made no judgment as to rate adequacy, as to movement in price terms and conditions. And so you're really just kind of dumb drone capital. I don't think that's what investors look for when they invest money in underwriters. And so, to me, I think it's antithetical to the commitment that we make to shareholders to deliver the best possible returns. But as I say, it's important not to lose sight of the fact that there are certainly circumstances where you can say, gee, this broker has this nice, attractive portfolio of this unique specialty class that I like to write, and I'd like to get access to all of it, and I'm willing to pay for that. As I say, perfectly sensible. But the rest of it, I think John is right. It's a soft market, and this is a way for people to track premium, and most of them will come to tears as a result. The results will deteriorate, and people will suffer major losses against it and move on, and those facilities will come apart.
But remember, you heard it from Ed first. Dumb drone capital. I mean, that is a great term.
Do me a favor, just keep that between us. That'd be better.
Don, any thoughts?
Yeah, you did mention Berkshire. And the fact is, Berkshire makes a ton of money because they're insensitive to volatility. Whereas a lot of other publicly owned companies would feel if one year they had earnings of $1 and next year they had a loss of $1 and so on, their multiples would be down. Berkshire said, look, we'll take that risk. So they're writing a lot of stuff at 1% and 2% rates online, where the probabilities may be 1 in 500, 1 in 700. And they can happen, but within Berkshire, they're so large and so big, they just are not concerned about the volatility, and they make a ton of money that way. I was surprised in business insurance this week. I noticed that Berkshire Hathaway was the largest insurer of medical malpractice in the world, far bigger than any of the companies. So in a lot of these high volatility rates, Berkshire can take it and take enough of it and be so big that they make a ton of money, and every once in a while they get clobbered, and the market just ignores it.
All right, 1 or 2 more questions from me, and then I'll open up one final time to the audience. It's great to hear about the health of the industry at the moment. There are tough challenges you're all facing. We're all playing in the same playground. How do you think about differentiating your own organizations in the context of working with your own customers? What are some of the things that you do to differentiate yourselves?
Yes, you mean first.
Don, start with you, yeah.
Okay. It's interesting because it is amazing. It's a commodity product. And yet, if you look at the class of '93, 8 companies were formed. And the outcomes were 8 different companies. It's really a great business school study to see the difference. So that there really is value in underwriting and risk management and analytics. Then there's the issue of capital management, and a lot of companies are good at that as well. And you look at the long-term prices of a number of securities, and you see that those who did really good capital management also look at their 5-year, 10-year, and 20-year charts, and you'll see they outperform people. So the answer is we look at opportunities, we use analytics, and we try to do capital management.
Ed.
I mean, in our case, Arthur, we started out as a catastrophe reinsurer, and we made a very big investment in our analytic team. And I would compliment Don. Ariel was, every bit as good as anybody in the marketplace in that regard. But as we've continued forward, we've continued to invest there. And we feel like to differentiate in the marketplace, we have to be more valuable. How do you differentiate a commodity product? Somehow offer value to the customer. And so if you think about the catastrophe business, this capacity matters, the security matters, your stability as an underwriter matters. Lots of people offer that. We've tried to go a step further and have the greatest insight and expertise to catastrophe risk that we possibly can, and then push that back to the clients and share it with them. So a good example of that is if you think about Sandy last year, it was really the storm surge that caused so much of the damage to the industry. We felt that the big modeling company that most people use was using the wrong storm surge model. They were using a Danish model as opposed to the one developed by FEMA in conjunction with U.S. Academics in the industry. We said that. We said that to our clients. We didn't adopt the Danish model. And we shared that feedback with our clients well ahead of Sandy. We said they've got it wrong. This is not the right storm surge technique for the U.S. coastline. And so if you're a client of ours, you had a lot more insight to storm surge in New York Harbor and Long Island and Connecticut and New Jersey than simply relying on the models. You don't get the chance to actually prove the differentiation very often. But when events happen is the chance that you get to go back, look, recalibrate, et cetera. And so that's, I think, truly value added. People who are purchasing reinsurance saying, well, if I'm concerned about my New Jersey coastline exposure, and the big modeling company is using the wrong flood model, these guys, are probably people I should be listening to and maybe buying some more product from, or at least hopefully it works that way. So that's really our entire view, is figure out how to make ourselves more valuable to our customers, and that tends to be through deeper analytics and insight.
I think on our side, because of our emphasis on the investment returns, it gives us maybe a little bit more freedom to be more opportunistic on the underwriting side. We really have two segments of our business. One is, we're out there slugging it out with everybody else on, the commodity type deals, trying to find the deals that do meet our risk return parameters, and that's tough, right? So, everybody's trying to do the same thing. On the other side, we have certain advantages, being small, working with smaller, medium companies that might have issues that a bigger company won't take time to sit down and talk to them. We've done several deals where, if you look at a company's capital charge in the S&P models, there's a big reserve charge for the capital adequacy. So their companies are carrying big amount of reserves. They're getting a reserve charge. They're making no investment income on those reserves. It's not a question of are the reserves adequate or not. It's just there's a price to be paid for carrying those reserves. They can't do anything with the money on the investment side. We're the flip side of that. We're not capital constrained. We have plenty of capital to support our business. We can take a chunk of the reserves because of the investment returns we think we can make, and we can share some of those returns with the company. So we just try to find areas that are a little bit off the beaten track. Companies, even the best companies, have issues here and there that we can help them on. So we try to play both sides of that.
Thanks. Okay, one more question. I mentioned in my opening remarks Bermuda and the state of the Bermuda market at the moment. All three of you have been invested in this market for a very long time and continue to be. Perhaps you might just provide your own thoughts of the state of the Bermuda reinsurance market today and some opportunities for it as we move forward. Don, starting with you.
Well, Bermuda continues to dominate the catastrophe market. And notwithstanding the fact that several companies have re-domesticated, the catastrophe business is still here. And when it was just reported, I forget which commission, but over 60 new companies actually formed in Bermuda. The second thing is a wave of hedge funds that are looking at Bermuda to manage assets through a Bermuda-based company, becoming insurance companies as opposed to being investment companies. There are some tax advantages and there are some other advantages for them. So Bermuda continues to be the center for it, and you can, within Bermuda, in a relatively short period of a few blocks, place massive amounts of business. So Bermuda continues to be the center of this market.
Ed?
So having been around for 8 years, we're now an old model legacy company, this whole catastrophe thing. But I think actually what John has done is an area that we should all be focusing on for the Bermuda market into the future. Pairing up really high quality underwriters and management with really high quality investors is a great model. Hard to do that in the U.S. today. I think London does a reasonable job, but less emphasis on high quality investors. And so that's a natural area that Bermuda should be looking to build their, ostensibly there should be lots of companies that follow John's that, try and mimic that strategy. I think it's an excellent strategy for investors, and obviously the way the company has gone public and the stock is traded, people understand that. And so I think for Bermuda, We are the center of catastrophe risk, will continue to be. There's lots of other kind of risk classes that there's, genuine expertise on the island for. But we should be trying to attract more management teams like John's and investors, like Third Point, to build these companies, because they're real companies, they bring real jobs, they further the island's importance in the global market, and I have to believe that they'll play a much bigger part of the industry, as you look out over the next 5 or 7 years.
Thanks. John?
Yeah, I think the challenge for Bermuda is that every developed nation in the world, the government's talking about how do we create jobs, right? We talk about in the United States, they're talking about it in England, they're talking about it in France. I mean, everywhere, that's the issue. It's the issue here. I think Bermuda will always be a center of reinsurance and insurance. We have the risk takers, we have the capital, so that will always exist. What about all the other services that go with that? The accounting, the finance, the computer modeling and everything, and you're starting to see it's a global economy. You can put those functions in places that are cheaper. So the challenge for Bermuda from the employment standpoint is how do you attract those jobs here? To me, Germany is and it's not our business, but just a parallel. Germany is a great manufacturing company. How do they do it? They manufacture things that really are expensive, that the cheap, China cannot, to date anyway, can't compete with the quality, so they can charge the right price. So how do we bring the quality of every level of service we provide in Bermuda up so that we can continue to maintain the standard of living we have here, we can create jobs for people? It's a huge challenge, and if we don't do it, other people are thinking about this every day. If we don't do it, it's just going to be a steady decline. So it is a battle, economic battle out there with the rest of the world.
Well, thank you for your time. Gentlemen, thank you very much indeed. It's a very insightful and interesting panel. I've certainly enjoyed it. I didn't get too hard a time from you, Ed, so thanks for that.
Again, Arthur, you do sign my financial statements. You should know.
So, ladies and gentlemen, please give a round of applause to Don Kramer, Ed Noonan, and John Berger.